Hello and welcome to this ByteTree webinar in March 2026, where we talk about Bitcoin and gold. With their different and perhaps surprising reactions to the recent burst of conflict in the Middle East, it's a fascinating time to dive into both assets. And we're joined today by the perfect guest for this exercise, which is Charlie Erith. Charlie is a ByteTree board member, having launched the Bitcoin and General Fund with us in 2021 before taking it to Wiston Capital in 2023, following a 25-year career in fund management before launching into crypto in the most recent 5 or 6 years. Charlie, welcome. Thanks very much for joining us. How are you today?
I'm well. I'm well. Thank you very much, Kit and Charlie, for having me on board. It sort of feels a bit like coming home. I also used to have to stare at Charlie every single day for several years. Nice to be back.
Nice.
How are your memories of that, Charlie? Do you have nightmares at night?
They're all good, Charlie. They're all good. I think it's, but they say about crypto, don't they, that it's learning about crypto is like trying to drink from a fire hose. And those were my early days, and there was an awful lot to take on board. So it was interesting.
Yeah. So I think one of the big differences, I was into Bitcoin some time ago, and then you came into it, but then I stopped at Bitcoin. I never went down the rabbit hole like you did. You went much further down, and we'll come to that, shall we?
Yeah.
But first, I want to talk about Bold, and I know you know what Bold is, but I'm going to pitch it to you anyway because you probably haven't heard the full story for a while. And feel free to interject whenever you like.
Thank you. I will.
So off we go. Bold is the invest in the ByteTree Bold Index, which is Bitcoin and gold risk weighted. What does that mean? We'll come to that. So firstly, there's a disclaimer, which you should please read at your leisure. Okay, we'll start with a Ray Dalio quote. He said, "I would take the gold. I would like to sprinkle a little bit of Bitcoin into that mix too." So he was early to recognize, like us, that these are complementary assets. What Bitcoin and gold have in common is they're both limited supply, they're alternative assets, and they're highly liquid. Gold trades around $150 billion a day, and Bitcoin around $50 billion a day. And this really makes them stand out. And so when we talk about alternative assets, which are not financial assets, they don't have a yield and that sort of thing, these are the two top picks that you can put together. And the low correlation between them is extremely important. And that's what Bold's all about. So at ByteTree, we're a research house, but I won't go into that now. Just to say that we have this asset allocation framework that we've run for many years. And in portfolios, when you've got high inflation, the assets on the top tend to do better. When you've got low inflation, the assets on the bottom. And when things are going well, the ones on the right outperform. And when things are going badly, the ones on the left. And that's a pretty simple framework. And so, gold is is an asset that likes it when inflation's there, and we know that the value of money is falling over time, but also that bond yields are falling, which typically means risk off. And that's basically a similar condition to inflation-linked bonds or TIPS. But on the right, we've got Bitcoin alongside value assets. So here we like the bond yields to be rising when the economy is probably doing better. Now, bond markets have been strange recently, doing different things, but nevertheless, this is the sort of long-term thinking of how these things work. What do we mean by value? Well, that would be the banks, the insurance companies, heavy industry, commodities, things like that. And so really in a Goldilocks world, when you've got low inflation, bonds and equities will serve you fine. But at times of uncertainty, to have some alternative liquid assets in Bitcoin and gold makes a lot of sense. Charlie, I think you're probably with me so far, aren't you? Any disagreements?
No, absolutely. I mean, it's just a particularly fascinating time, isn't it? Because we're in this sort of elevated risk period, which would normally suggest some form of transition between these regimes, in my view.
Yeah,
totally agree.
You always get transition in the regimes when there's a shock in the market. Otherwise, there wouldn't be a shock. So how do we put Bitcoin and gold together? The simple idea here is that if you've got $100 and you put $50 into Bitcoin and $50 into gold, I think most of us would recognize you've got more risk in Bitcoin than you have in gold. So we use volatility to equalize that. So we see how much the assets move on a typical day. And obviously, in recent months, both assets have been very volatile. Gold going up a lot, then down a lot, and Bitcoin really stable in the last couple of months, but having had a pretty poor autumn and early start to 2026. But nevertheless, looking at 360-day volatility, Bitcoin was once a very volatile asset, but it's been calming over the years. And gold, having been really stable, its volatility is now rising. Now, the dotted lines show 180-day volatility, which just shows you the direction of travel, where we think these lines are likely to go over the coming months. Now, we use that data, and our index agent called Kaiko, or Vinta, or it was Vinta, taken over by Kaiko, who are based in Sweden, and they put those volatility numbers on the left, and they do some simple calculations, and these are not particularly original calculations, they're standard financial maths. And out on the right-hand side come the weights. Now, they do this exercise once a month, and they tell us what the bold index, how much you should have in Bitcoin and how much you should have in gold. The simple point that's worth mentioning is that if you put the same numbers on the left, whether it's 10 and 10 or 50 and 50, out on the right comes 50-50. If you put different numbers on the left, then they invert. And so if you've got one asset more volatile than the other, it will get a low exposure.
This is amazing. This is absolutely amazing to see Bitcoin at over 40% of this mix. I mean, I do you remember, Charlie, when we first sort of launched it, and it's all your idea, of course, but we had these sort of big debates whether we should do the inverse volatility method or whether we should have a fixed 2080.
Yeah.
And you just look at the beauty of this and the way it's kind of rebalanced. And, you'll be aware of this, but it's a chart I produce in my newsletter, which is Bitcoin priced in gold. And as far as I can see, this is the recent crash that we've had in Bitcoin is the worst of the last three. So we're at that point where it totally makes sense to be transferring out of gold into Bitcoin. And the beauty of the monthly rebalance is that it's giving you a great weight to do that based on the risk factors inferred by historic volatility. It's just amazing how this has moved.
So, I mean, I'm glad. I mean, I remember all the discussions back in 2020 when we were designing Bold, and by God, there were thousands of ideas, and we settled on this one. But the history is amazing. So by risk weighting, in late 16, when Bitcoin was still quite calm, 25% of the Bold hypothetically was in Bitcoin, 75 in gold. Then in 17 and 18, when Bitcoin went crazy volatile, it was down to below 10. It settled after 2020 at around 25% for a while. And then in the last year, Bitcoin's volatility hasn't changed much, but it's gold that's gone through the roof, and that's really pushed it much higher. So we had a 46% target weight last time. And that's was incredibly timely because gold's just had its correction. But that's one part. That's the riskiness of the portfolio, by making sure we've got the same amount of risk in each asset. But the rebalancing mechanism, and this is over the last 2 years, is illustrative. It just shows you that in a month like this, in late 24, you had a Bitcoin rally, so you're rebalanced there, and then Bitcoin goes up, and you take profits at the end of the month. And then you have a bad month for Bitcoin, and then and then at the end of that month, you're adding back to it and reducing gold. And you keep doing that process, and it serves two purposes. One, it's buying low and selling high, which is a good thing to do in volatile asset prices, particularly when they have low correlation. And the other thing is it's maintaining that level of risk. Because if you didn't rebalance, for example, we all know that since October, Bitcoin has gone down by a lot, nearly a half, not less now, but at its worst. And if you didn't rebalance, then you'd have a very, very low weight in Bitcoin. And it wouldn't be gold anymore. It would just be a lot of gold and a tiny bit of Bitcoin. And so by maintaining that status quo, it's quite important. And all of this, if you believe both assets are going to be strong long term, which you and I do, you're obviously more of a Bitcoin bull, and I try and be more balanced. But nevertheless, we've now got tons and tons of Bitcoin in the portfolio, which has been stable during the Iran month, and hopefully we'll be taking profits. And settling down again. Who knows where these weights go? But I always said 50-50 wouldn't happen in my lifetime. But markets are markets.
Yeah. And of course, the beauty for an investor is it takes the emotion out of it. You know what we're all like. I mean, there are huge. We have huge behavioral flaws. And when gold is shooting up, everyone's like, "It's going to shoot up forever. I better have some more silver to go with that." And that's when you kind of should know that we're getting to the top of the market. And ditto Bitcoin, and so this provides a discipline to a long-term investor who wants to have an allocation to hard money. It's this is how it should work. You're taking out the decision-making process from your behavioral your behavioral issues.
Yeah, biases, and
Yeah, that's it.
absolutely right. So, Charlie, let's sort of run through the performance because there's the performance and there's the risk, and then the third good thing about Bold is the peace of mind. Um, but looking over the last year, I mean, it hasn't been that pretty for anything recently. Gold peaked in January, failed to make a new high, and has been. I don't think it's been a bad asset during the war. It's not in Iran. It's not like you don't want gold. It was just red hot coming into this. I think that's more important. And then we had real interest rates going up in the bond market crisis. So interest rates went up more than inflation expectations. We had a dollar rally. So all the sort of things gold doesn't like. And of course, maybe there was some central bank selling in the panic, which wouldn't surprise me at all. But anyway, it's done what it's done. Gold's up 48% over the last year. Bitcoin has followed the software sector down and is down 20% over the last year. The average is 14. Somehow or other, Gold's down 23, which is an excess of 9% over the average. So we'll look at that over a couple more time frames. This is the 5-year performance. Now, it's really rude to publish 5-year performance in Bitcoin because it's taking us to the top of the 2021 cycle. But it is what it is, and I'll keep doing it. And in a year's time, it will start to look much stronger. But nevertheless, Bitcoin's up 30% in the last 5 years. Gold's up 158, the average of 93. Bold 151, which is an excess of 57.8%, which is quite a lot. And basically we've had one of the best runs in gold in history, and Bold's basically up there with it, which is pretty good. And then finally, I'm going to take the top of the previous cycle, which is 2019 December, when Bitcoin nearly got to 20,000, and since that time, the magical bit here is that Bitcoin and gold are the same.
These are crazy numbers. They're just crazily good.
Yeah.
And why everyone hasn't got a little bit of this in their diversified portfolio, I just do not know.
So, well, thank you, John. The check's in the post. So, so Bitcoin and gold. I mean, I just love the way they keep crossing over, and we keep expecting Bitcoin to take off like a rocket, and I think that's going to happen. But so far in this environment, they do keep mean reverting. So the average of Bitcoin and gold 261, Bold 416, and an excess return of 155%. This is the Bold index, of course. And then now to the risk, which I think is probably more important for many people. We've shown this chart before with Bitcoin volatility and gold volatility, but the bit I like is Bold. So what you get with Bold is you're taking the volatility not from the average, which would be sort of somewhere here, but right down to gold's levels. And remarkably, this year, we've started to see Bold trade with lower volatility than both Bitcoin and gold. And that can only be explained by the low correlation between the assets. And if you did it with gold and silver, you would not get that result. If you did it with Ethereum and Bitcoin, you would not get that result. Indeed, if you did it with French and German equities, you wouldn't either. People do it with bonds and equities. You get some benefit from that, but not as much as you once did. These are two very interesting assets with very low correlation, which I think is why they stand out. You can't do this with many things, or in fact anything that I've found. And why is that low correlation? Well, we spent a long time, Charlie, you'll remember the pain we went through making this data set. But all the ETFs in the world in gold and Bitcoin, we're probably behind by a couple recently, but we've got enough. And this is on the right-hand side, billions of dollars into or out of those assets over the last 90 days. Gold was looking at 35 billion of inflows a few months ago, and now that's approaching zero. Bitcoin was experiencing outflows and is now back to neutral. But I just love the way that these assets bounce against each other. They're demonstrating that investor demand is always one or the other, and not necessarily both. The other point I'd make is the Bitcoin line's a bit flat on the left of the chart. That's because America hadn't begun. America began in the beginning of 24, so the numbers were still quite small. You didn't have these surges of money coming in and out, which of course you did with gold, because that was already a well-established asset in ETF land. Quick check-in on the industry. So we were $700 billion of Bitcoin and gold in green. Gold's obviously come off quite significantly from 600 to 500. Bitcoin's come down from 200 to 100. But nevertheless, I expect those two lines to converge quite a lot over the next year or two. As you said, Bitcoin used to buy 12 ounces of gold 2 months ago, and now buys 16 ounces of gold. So we've probably got that turn underway. Oops. Drawdowns. Now, going back to the 1970s, I don't think Bitcoin was around then, but gold certainly was. A big drawdown in the 1974 oil shock, or 5 after the oil shock. And then we had the 80s and 90s when gold went down quite a lot because the world was perfect and the peace dividend and inflation kept falling and that sort of thing. Who needed gold in that era? And then in the 2000s, gold becomes relevant again, but it has a small downturn in 2008, a large one, 45% or so in 2013 to 15 when real interest rates rose, little one in 2022 in the pandemic, and then recently there's been a bit of a drawdown. Bitcoin, shorter history, but 90%, 80%, 80%, 75, and fingers crossed, less than 50. But then this is bold on the same scale, 0 to 100. Because of the low correlation, gold hasn't had that large drawdown. I mean, I'm sure it will have one day when the world's fine and all the governments balance their budgets and both assets become irrelevant. But I think it's a long way off, and you can really see the dynamic. And certainly holding gold is no worse than the average in that sense. Another way to measure the risk is looking at the top 7 Mag 7 stocks, and then we've got Bitcoin, gold, and gold. And that one up there is Tesla, Nvidia, Meta, and then we've got Amazon, Google, and Microsoft. So not that volatile. And we've got a Sharpe ratio table here. Bitcoin over the last 8 years, going to the end of this of 25, roughly 25 annualized. Gold 20 annualized, which is very high for gold. Probably should be more like 10. And then gold 25. So similar return to Bitcoin, but with far less volatility. And so therefore a very strong Sharpe ratio. Fund managers love Sharpe ratios. If you can pile up a list of good Sharpe ratios, then you'll do very well. And then, probably one of my favorite charts, which is the relationship between gold and the money supply. As all the commentators will tell you that Bitcoin goes up when they print money, and the gold commentators will tell you that. But neither line is particularly well correlated to the money supply. And this is G20, and it was $60 trillion 10 years ago. It's now $114 trillion, off a bit in the last month because of the dollar rally. But essentially, you've had nearly 7x outperformance of gold against the money supply over that 10-year period. If you did it with global equities, you do get a similar correlation, but you get 1.3. So it's the bang for your buck. If you believe that we're living in a world where they're going to print money, then this is a very efficient way to participate in that idea. So, 3 reasons to own gold. I think I alluded on this earlier. The most important one is to reduce risk and take advantage of the low correlation of the assets. Then the fun one, that you get higher returns because of the rebalancing transactions. And as you said, Charlie, it's not an easy thing to do yourself emotionally. But I'd add to that, the 21 shares trade once a month at the London Gold Fix at 3 p.m. On the rebalancing day. So there's a minimal spread on the gold. And there's also a Bitcoin fix at that time, and they trade there. And so the whole thing's done really efficiently, which is great. And the other thing, this is really this is for people and for advisors. If you own both assets, one of them is always going to be a good story and the other is always going to be a nasty story. But if you put them together, you just don't notice and you move on and you have a very, very calm ride compared to holding them individually. That's the ETP, and we listed in Zurich back in April 22, so we're nearly 4 years old. So it's a very exciting moment coming for us. And then different listings that come on. Germany came around here and started to move. Listings in France and in the Netherlands and in Sweden, and then more recently the London Stock Exchange in pounds in blue, dollars in black London, Bolu, and then even more recently Milan in yellow. So the fund's $40 million, and the volume is now growing every month. So that's nice to see. Some details which you can get these things on our website. So I don't think we'll bore everyone with them right now. But just to say, boldetf.com is a fabulous, rich data source where all the charts that we've shown you can be found. So I'll leave it there, Charlie, and let's dig in. Are there any slides you want me to refer to quickly before we chat, or are you happy?
Not in particular. I'd love to know what you think is the kind of general gold and Bitcoin ownership out there amongst kind of sophisticated investors.
Yeah, well, like my quote is, I think I got it from the Credit Suisse Wealth Report, that the wealth management industry is 170 trillion, and I think you can say they're between 1% and 2% gold.
1 and 2.
1 or 2. Bitcoin, I would say it's close to 0.0. So that's the biggest bull story in town. You know, this asset is still here after all these years. It's big and liquid. It's got great foundations. It's got low correlation, not just with gold, but with lots of with assets in general. And they're going to buy it. In 10 years' time, they're all going to own it. And so what is the weight in the $170 trillion wealth management industry going to be?
Yeah,
something approaching gold.
Yeah. No, I completely agree with that. I think the other thing, of course, is it's very interesting is that neither Bitcoin or gold are subject to passive flows, which I regard as a good differentiator as well in the context of how markets move. I mean, it's been very interesting to me, as I reflect on it, because Bitcoin, of course, was really oddly weak at the back end of last year, and I think a lot of people expected it to be strong as gold started surging. But actually, it's been a very good sort of smell detector, I think, of things starting to go wrong in markets. And it interests me a huge amount that since the start of the Iran war, Bitcoin has been finding a bottom. It's not what you would traditionally expect, is it really?
Yeah. Well, I think there's a couple of points about that. One is that, the chart that's done the rounds, and we've published it several times, has been the software ETF. And, Bitcoin is correlated with that, and software's had a good March as well. And I think that there's a couple of points to make. One is that when you start to see bombs blowing up physical assets, and don't forget the narrative in January, February was physical beats digital, suddenly that flips back to digital. And so everything that's sort of, soft rather than hard becomes quite interesting. So I think there's something in there. And the other point is the 4-year cycle, which everyone attributes Bitcoin to the mining cycle and all the rest of it, but it doesn't explain the relationship with tech. It can't be that Bitcoin drives the tech industry. It can't be. So there must be some 4-year cycle that's above and beyond that. And I think that's pretty interesting. But the other thing is, there is a physicality about data in the sense you can bomb a data center, as we've seen that as well, but you can't bomb a decentralized network.
Yeah.
And so, Bitcoin's value is really highlighted in that sense during these difficult times. I don't like the idea that Bitcoin goes up on war particularly, but it is a diversifier. It's something else out there, and it's different, right?
Totally. Well, I mean, when I do the correlations, I mean, even the correlation with software since the start of 2024, which is kind of what I think about, because that's when, well, basically it's the easiest time to get data because that's when the ETFs were launched in the US. It's not particularly, it's not particularly hard. And it wouldn't surprise me if Bitcoin just sort of does this continued thing, which it's always done, of hitching itself onto something and then losing it. So the correlations are constantly breaking down with Bitcoin. But the other thing that interests me is kind of cycles within cycles, if you like, or the sort of structural demand stories. And I think gold has got one. I think with this kind of idea of a sort of payment systems, particularly in the sort of emerging market China type world, being increasingly structured around gold, which is a fascinating evolution. And of course, with crypto, which is what interests me finally about finding use cases, is this proliferation of AI and the way that crypto technology, blockchain technology, will feed into that. So for both of them, I feel you've got stories that are evolving, which are structural demand stories, and not just sort of macro cyclical, if you like. So it's a kind of, I regard both of them as being a buy at the moment, particularly gold. I mean, if people have been waiting for an opportunity to get some gold on board, this has surely got to be it. You've got what looks like forced selling coming through from Gulf states. Absolutely classically, it's bound to have been over leveraged in parts as it's bubbled at full force, right? But I think those structural drivers will remain firmly in place.
No, sure. So what else? I mean, you've gone further down the crypto rabbit hole, yeah. Whereas
Yeah.
I sort of never really got past Bitcoin, but I can sort of blag my way in Ethereum and all the product, all the things that we hold in the Bytefolio, which
Yeah.
Ali, the analyst, has come up with. But you've gone much further down. So what do you see in the space, and what are you doing at Wiston?
Yeah, so the fund we run is called the Bitcoin and General Fund. Actually, we're changing the name to the Wiston Digital Assets Fund, actually, because we are actually slightly de-emphasizing Bitcoin, having been heavily exposed to Bitcoin through the last few years. When, to be honest, and to your point, it was very hard to identify where the proper use cases were going to emerge from, and to analyze them properly. But that's why I think this is a kind of sector in transition, a very interesting phase. I mean, my view was always you should never ignore new technology, however ridiculous it seems at the time. And I think, blockchain and crypto definitely went through a 10, 15-year period of being ridiculous to the outside world, but nonetheless, it didn't go away. And I think it's probably right to say that blockchain was a solution looking for a problem, which a lot of people sort of threw it in the pejorative. But I think that problem is emerging with things like AI. I think that the idea of kind of decentralized distributed networks is a very powerful one if it can be made to work, if it can be made accessible to many. So my view has always been that the use cases would come through. It's just taken a lot longer than I thought it would. And to your point, yes, I think Ethereum is absolutely fascinating. It has become the sort of foundation stone of the decentralized finance network. And within that, there's a huge amount of development, which of course no one knows anything about because we've been in a horrendous bear market and no one cares, which is actually always the most sort of fascinating period in any market. Emerging markets for a long time. Normally, when everything was smashed up, the most interesting things emerged. But it's not just decentralized finance, it's AI, as mentioned before. It's decentralized infrastructure, such as telcos and power using this technology. And we know it's kind of coming forward because, you've got BlackRock, Goldman Sachs, all these people, pharmaceutical companies using the technology and trying to figure out how best to use it, which makes total sense because it's just an easier, quicker, more secure, more transparent way of moving value around the global internet. And so that's going to happen. So our job really is to construct a portfolio of 15 to 20 projects. We only invest in the tokens and coins, which makes things more complicated because, of course, they're not equities, and we have to figure out the value structures for them. And we hope that a number of these things will be a lot more valuable on a 5-10 year view.
Yeah, I think there's another point which I'd make is there are a million crypto projects. Most of them are rubbish, as we know, Trump coin and stuff. But there are several very, very serious projects out there which are going to generate a huge amount of value. And I just like to tell the story of in the 1990s during the internet boom. Some youngster like Kit with a good idea would go and list a stock on AIM or OFX, but you just can't do that now. It just costs too much money. And so they've all gone to crypto. So there's a whole generation of people that have set up tech projects through crypto, which is, it's a different asset class, a different approach, but they're basically companies in most cases, aren't they? With a slightly different output. But they're trying to make money at the end of the day. And that's what it is. It's an alternative equity market in many cases.
Yeah, I think that's exactly right. I mean, I sort of joke that I've got a sort of venture capital fund with prices every second, which isn't exactly good for the blood pressure. Do you know what I mean? But that's what it is. And the liquidity is one of the fascinations about it, is that we can come in and go out of things if they fail or if they succeed, which of course you can't do in venture capital. And it democratizes the space. And so it's no wonder, of course that lends itself to speculation very naturally, but in a sense, speculation is not a bad thing. That's how capital gets allocated to entirely new ideas, and it's happened since the dawn of time. Every time there's a new sort of technology comes along, you have a speculative bubble, and that's your R&D allocation, to all these smart young guys. So yeah, we've managed to avoid, I think, most of the horrors. We've done a good job of that, principally by being very heavily exposed to Bitcoin, actually. Until we saw sort of better things happening. But I think that's the big change for us at the moment. But don't worry, Charlie, I'm still very interested in gold, particularly in a personal capacity. I think the two absolutely live, cheek by jowl.
That's because you might be over 50, or I wouldn't wish to speculate. But I think the story here is very clear. And back in the day when when you went to set up Wiston Capital, I was very focused on the macro Bitcoin gold, and you were very focused on the space, and that was the difference, wasn't it? Which is, I think we've both found our happiness. But Kim, do you have any questions for Charlie?
Well, one thing I just wanted to pick out. You talked about how Bitcoin had these various correlations, and we've looked at software at the start of this year and how that worked. But you said those correlations don't last very long, and I was wondering why you thought that might be.
Well, it's simply just by sort of crunching the numbers. I mean, I did it from the beginning of 2024, as mentioned, Kit. And when I found, I thought the correlation on a monthly basis with a software ETF was about. So it was correlated, but it's inversely correlated with gold. The numbers for the SPX, all these sort of things weren't actually, as far as I could see, that high. And that's because I suppose the narrative around Bitcoin does change over time. At times it's a kind of money for the internet. At times it's a sort of digital gold, and it makes sense. The difficulty Bitcoin's always had is that to explain it to someone is very difficult in under a minute. So it gets sort of categorized as digital gold, which for me is an unsatisfactory categorization, because it's really a sort of peer-to-peer monetary network, and there are complications around it. But nonetheless, if it's digital gold, therefore it should behave as digital gold if that's why you own it. Do you know what I mean? And so I think its identity kind of changes over time as people sort of figure out what it is, and that's why it goes with tech sometimes, why it goes with gold at other times, and why it's really, I think, more helpful to kind of expect it not to be correlated to anything, and just to hold, a small allocation in a proper, properly diversified portfolio.
Or gold, of course.
But obviously bold.
Well, exactly. That was my sort of follow-up question, was the inverse correlation with gold is something you guys talked about coming up with 5 years ago, and that has held over the 5 years, whereas against lots of other equity themes, maybe they've come and gone. So I was just curious why one of those relationships is held and the rest have come and gone.
Yeah. Well, I don't know. Maybe that's about to break down as well, and it become very correlated to gold. I mean, if we're right and both assets are applied now, then that's the case, right?
Yeah. Well, I mean, my take would be that Bitcoin is a technology, and it's related to the internet. Obviously, it lives on the internet, and the internet and the real world are different things, and they're both growing at different speeds. And the internet goes through surges in innovation, whereas the real world's a bit more consistent and steady and slower and all that sort of thing. But gold is the most liquid non-financial asset in the real world, and Bitcoin is the most liquid non-financial asset on the internet. And you'd always associate growth investing with risk on and gold with risk off. So I don't think they will become correlated anytime soon. I think that lasts. And I'm not just saying that because of Bold. I mean, I wouldn't have bothered with Bold if I didn't believe that was going to last for the long term, because it underpins the entire strategy. But of course, if they become correlated, as I say, you just get the average, and it wouldn't lose you.
It's not a problem.
It's not like the rebalancing goes in the wrong direction or something like that. It just means you get the average, and that's fine.
But the great thing about Bold is you don't have to make that decision. It'll deliver you, exposure to these two tremendous assets. Right.
Yeah. No.
One other thing I was curious to ask about, if I just may, is in the drawdowns chart that you showed, Charlie, and we've talked about how gold has fallen in this war, and that's a sort of big theme, is it hasn't provided a safe haven. But it looks like in 1974, which we did a study of last week, gold also had quite a big drawdown then, so it just doesn't love an oil crisis.
Yeah, it doesn't love an oil crisis. They're different boxes, so I think that my money map is not awful. I mean, it doesn't explain everything because there are realities in the world, and you've got valuations, hot and cold sectors and all these things. But the big picture, if you're going to have a two-factor model for asset allocation, I think it's pretty effective. There are other things you need to consider as well, but long term, I think that's very important. But look, Charlie, I'd just like to say thank you so much.
Pleasure, Charlie. Congratulations on how it's gone. It's amazing.
Yes, we haven't talked about London. We listed in London and now Milan, and retail investors will soon be able to buy it on the major platforms. With a bit of luck, they're coming. I mean, it's all been very, very slow. It's been a real grind, but it's sort of funny because it is a good product with a good history, and I think people are very interested in it. But people really are still wary of Bitcoin. And it's 17 years old, and $50 billion a day, and pretty established. And
yeah. I mean, it's not surprising. I mean, it's a really high bar from a regulatory and reputational perspective, and all this sort of stuff. We do a lot of education around crypto. We do, I do crypto boot camp, and we send out a survey to the professional money managers who come on. And one of the questions is, how long do you think before your institution will take this seriously or it will become investable? And it's very rarely that it's less than 2 years becomes an answer. I mean, because those hurdles, administrative, legal, reputational, regulatory, they're high, and until the asset class goes crazy. And outperforms and isn't correlated to anything in a very, in a difficult market or whatever market, it doesn't present, a strong argument for inclusion. So, we have to wait. We have to wait until there's a better understanding. So education is a big part of this.
No, sure. And Johnny, how can people find you?
They can find me on LinkedIn. At Wiston Capital and under my own whatever it is name, and also at info@wistoncapital.com. Should get to my inbox.
Fine. As I said, thank you very much for coming. And Kit, anything from you?
No, perfect. Just the perfect time to come and listen to all of that. So thanks for coming on.
Absolute pleasure. Great to see you guys.